What's up? This is Ryan with Planet Cheapskate. In this video, we're going to be talking all about the loan estimate. What is the loan estimate? What is the purpose of the loan estimate? The loan estimate's relation to the closing disclosure. And finally, I'll be going through a loan estimate example to teach you everything you need to know and to be looking out for when you are presented with your loan estimate. Also, be sure to stick around for a very valuable loan hack regarding the loan estimate at the end of this video that will help you find the best deal on your loan. But first, I'd just like to take a very brief moment to personally invite you to subscribe and join our community. I do a home loan rate update every Friday going into the weekend, along with a new video every Thursday helping you manage through the world of real estate and home loans. Also, when you do subscribe, be sure to hit that little bell and it'll alert you whenever I release fresh content. Now, with all that out of the way, let's dive right in. So probably the most important document you will receive when completing your pre-submission loan documents will be your loan estimate. The loan estimate should look the same regardless of lender. It's required once you've given the loan officer many personal details and documentation along with a property address. Now, even though the loan estimate, which we shorten to LE in the industry, is only a few pages, it has a wealth of information. Stuff like what your interest rate is estimated to be, critical details of your particular loan, all the cost and fees associated with your loan, and much, much more is included. So what is the loan estimate? The loan estimate is a 3-page form that presents home loan information in an easy-to-read format, complete with explanations. This standardized document not only makes the information easy to digest, it also makes it easy to compare offers among lenders to assure you're receiving the best deal. Any lender must provide you with a loan estimate no later than 3 days after receiving your 1003 application. The purpose of the loan estimate is to give you an easy-to-read, good faith estimate of what your interest rate, loan cost, and closing fees will be. Everything should be included in this document that you will be expected to pay at your closing. If anything changes, then you will receive a new loan estimate. And in fact, if the changes were not included in the loan estimate, they are not allowed to be charged at closing. And if the fees vary by over 10%, then a new loan estimate will have to be issued, or you may have to start the whole loan process over again. This document is very, very important. So next week I'm going to be going over the closing disclosure, but there is a close relationship between the loan estimate and the closing disclosure. The loan estimate you receive first should give you a pretty accurate picture of what will be on your closing disclosure at the end of your loan process. All the fees and charges that appeared on the last loan estimate you received should also be present on your closing disclosure. These two documents go hand in hand and are both standardized regardless of lender, and are probably the two most important documents in all of your mortgage paperwork. So now that I've explained the definition and purpose of the loan estimate, I'm going to switch to screen share so we can go over a sample loan estimate together. And once we went through it thoroughly, we'll come back for a very valuable loan estimate loan hack and then wrap things up. Hey guys, Ryan here with Planet Cheapskate, and we are going to check out a sample loan estimate. And I got this at consumerfinance.gov/owning-a-home/loan estimate, loan-estimate. And you can access this too and review it on your own. There's a little bit of hints here. I'm just going to go off of what I know and some important details that you want to check out. But everything should be included in this loan estimate. It's a really, really useful document. But without further ado, let's get right into it. This is going to be the date issued. Very important thing, a loan estimate is good for 10 days. So after 10 days, your loan estimate will not be valid. If you're going to compare loan estimates at different banks and lenders, you really need to do it the same day because interest rates change just like the stock market per day. So you really need to give all the lenders an equal footing and check them all on the same day. So very important, date issued. They're good for 10 days. And just make sure your information is right here. And like I said, if you want to compare and you don't have an address yet, just use one that is in your price range. It should give you a good idea. But that stuff will be here. This is going to be your sales price, offer price, your loan term, 30 years, 15, whatever you're looking to do, purchase or refinance, fixed rate, or you could have an adjustable rate right here, conventional, FHA, VA, or other, your loan ID, and your rate lock. This is really important. So your rate lock, a lot of lenders will allow you to lock the rate before your offer is accepted. It's something really good in a highly volatile market like we have right now, where rates are like up and down as much as a 1/4% each each day. It's good to have an option where you can lock in the rate. Now, when you get these options from the lenders, it'll probably say no, which means your rate is not locked in. So you have the loan amount here, you have your interest rate here. This is your monthly principal and interest. So this basically is the money you're paying back plus the cost that you're paying it back at, which is your interest. And this is directly derived from your interest rate. Prepayment penalty, this will have your information. It's never good to have a prepayment penalty. This will have a lot of the details that are negative details of your loan. Balloon payment, you never want a balloon payment, it's a bad idea. Sometimes they're good if you're in an environment where you need to do like a multiple property investment. There are some times it's good to do, but mostly for residential, these are not going to be good to have. Your payment calculation, it's going to have your principals and interest. Mortgage insurance, pay attention to this. Anytime you put less than 20% down, typically you're going to have mortgage insurance. Mortgage insurance does vary by lender, so keep an eye on this number. It can go down, and if it seems kind of high to you, ask them, if you're working with a broker, ask them to shop around and see if you can get a lower mortgage insurance. Your estimated escrow, this also varies based on the property insurance and the homeowners, or the property taxes, and the homeowner's insurance of your home. You put this number here, which is your estimated escrow right here, your property taxes, homeowner's insurance. Put this number with that number and it should give you this number here. And then you also include your mortgage insurance. So your principal and interest, which is this number here, your mortgage insurance, which is this number here, and your escrow, which is this number here. Add those all together and it should be your total monthly payment right here. I know it's kind of confusing and it jumps around a little bit, but that's kind of what it is. Estimated closing cost. This is going to be your closing costs that you have with, so basically your prepaids and your, title fees, taxes, stuff like that is going to be here. Cash to close is going to be your closing cost plus your down payment added together, and all of your credits taken off too. So that kind of explains the first page here. Let's jump to the next page and I'll explain it. So this is a breakdown of all of your different costs and fees, where they are. Origination charges, these are what it costs you basically to get your rate from the lender. This should be the only cost from the lender that you have if you're going through a broker. If you are going through a bank or credit union, you should have some other fees here. You'll probably have an underwriting fee. You could have an application fee, stuff like that. When you're going through a broker and they are going lender paid, which is kind of a way to do wholesale loans, you should only have an origination charge here. So services you cannot shop for, these are things that you need to be aware of because these will not change. These are particular for the lender you're using and they will not change. You have your appraisal fee here, credit report fee, flood determination, and stuff like that. These fees do not change. These are the ones that you can compare from lender to lender and they will be different. Services you can shop for, these will also be different, but you can change if you're not happy with it. You don't, a lot of people don't realize this, but you can go to a different title company than who the real estate agent that you're working with is suggesting, or if you're doing a refinance, who the lender suggests. Shop around. I try to go to someone who is pretty reasonable, but they're just not as popular with real estate agents, but you can shop around this. These, if you want to change these, you're going to have to go to another lender. Okay, so here you have your government taxes and your government fees. These are typically the same regardless because it depends on where you live. Your prepaids, homeowner's insurance premium, and your prepaid interest. Your mortgage insurance, if you did not want to finance it, it would go here and you just pay it on as part of your closing costs. Property taxes, this is another thing that if your taxes are not billed in the rears and they're billed in advance, then your property taxes are going to be here. Homeowner's insurance premium is going to go here. And let's see, prepaid interest. I want to talk a little bit about this. So there's a time period where from the day you close to the end of the month, you're going to pay that interest. It's still charged and you're going to pay that at closing. Now the next month is going to be on your first payment. But there's a period of time that you close. It could be 1 day, it could be 15 days, it could be 30 days that you'll be responsible for that interest from the time that you close to the next month, and that's paid at close. Okay, your initial escrow payment at closing, this is going to be your escrow reserves, and this is just there's a formula and it varies by your location, but they're only allowed to keep a certain amount in there. But you have an escrow reserve for your homeowner's insurance and your property taxes, and sometimes for mortgage insurance, depending on your location, but usually always for homeowner's insurance and property taxes. Now, the thing about these is you could have too much at the end of the year and you get a check back, or there could be too little and they have to bump your monthly payment up a little bit. Your principal and interest will never change. If your payment changes, it has to do with your homeowner's insurance, which is 9 times out of 10, that's what it is, or your property taxes, which also sometimes go up, and especially in the environment we're in now with the appreciation of homes, property taxes have been creeping up every year too. So this is where your payment will change at, right here. Now, the reason they do these reserves is because they've determined that when people's payments change often throughout the year, there's a higher likelihood of them defaulting on their loan. And so by using these reserves, they don't have to change your payment in the middle of the year. Okay, so owner's title policy. This is going to be a title fee, and it's also something you can shop around with. If you don't like it, you think it's too high, you can try another title company. But it is going to typically be on there. A lot of times it's optional, but if you don't put it on, the title company will sometimes make up that fee by charging you something else. So it's always good to get it, just because what it does is it protects you against, who's selling you the property, who they are. Who says they own the property is who owns the property. So it's good to have on there. Any lender credits is going to be right here. So sometimes if you take a little bit higher rate, you're going to get a lender credit, or other things you may get a lender credit for. It'll be here, and it's going to offset your closing costs. So here you got your total closing costs, and then you're going to have whatever closing costs are allowed to be financed, which is oftentimes your mortgage insurance or funding fees or anything like that. That'll show up here. You have your down payment, and then you have any deposit, earnest money that you put down here, and funds for borrower and seller credits. If you have a seller credit as part of your contract, it'll show up here. Now, adjustments and other credits, this is going to be wherever you have, like if you have taxes paid in arrears and you receive a credit for a time you didn't own the home from the seller, this is going to appear here. Now, after all of your closing costs, your down payment are added together, all of your credits are taken off, that's where you're going to have your cash to close. It's going to be right here. Now, this is the figure that is only allowed to change 10% from what your closing disclosure ends up being. If this is any more or less than 10%, then that means that a new LE has to be issued, or you may have to start the whole loan over again if there was some different violations going on. So just be aware of that. This is where the bulk of the information is. This page in the first page. This third page, just verify everything's the same. It's going to have your loan officer information. This is going to be comparisons. Like in 5 years, it'll tell you like how much you'll pay total, and then how much of the money you borrowed, it'll go to it. It is kind of sad, and it is kind of a huge case to always try to term down and get a lower rate. And then also, if you are paying mortgage insurance, to get rid of that mortgage insurance, so more of it will go towards what you have borrowed. Your annual percentage rate. Banks and credit unions are huge on this number. I'm not so much big on this number as I am the final rate, because this number only really matters on the first year, because all of your fees on a mortgage are at closing. We're not allowed to spread out any of your fees, anything like that. So this annual percentage rate, don't be as concerned with this as you are like on a consumer loan or an auto loan. It's not as important as it is your ultimate rate, because after the first year, this does not matter. What matters is your interest rate right here. Okay. APR, most lenders are going to be about the same. Most of the fees are about the same. There may be a slight variance, but again, APR, not as important as some banks and credit unions might make it seem. Total interest percentage, this is another kind of sad number to look at. This is the total interest you will pay over the course of your loan. And not broken down annually. So another reason to refinance to a term down from a 30 or make that extra payment. And I know another thing I want to go into, there's a lot of people that say, oh, well, don't term to a 15, don't term to a 20 because you can just make an extra payment. Well, I'll tell you right now, you do that and you do a 30-year, you're hardly ever going to be consistently making that other payment. If you do, you have a lot of willpower and self-control, because typically people's expenses rise to their income and then you never end up making that extra payment. So a 15, a 20 is not a bad idea, because what it does is it forces you to make those payments, and then in 15 years you don't have a mortgage. You own the home free and clear and you're all good. I gotta kind of hurry this up a little bit. So other considerations, this is appraisal. This is gonna just say that, you know, basically you're gonna have to pay for the appraisal, and that's that. So this is an assumption. You do have the right under certain circumstances to have someone assume this note, which just is different than selling a home. They take on the same, you know, they take on the same interest rate, everything like that. And so good thing to have, you know, it's not always allowed, but sometimes it does. If they meet certain conditions, they can take over your loan. Homeowners insurance, it just says that, excuse me, this is just saying that homeowners insurance is going to be required. This is going to be if there's any late payment, refinancing, you have the right to refinance if it benefits you. If you are not allowed to refinance, it's going to state it here. And then this is going to say if the lender services it or if they transfer servicing to someone else. After all that, you review all that, you're going to sign here, and then that's when you have locked in your 10 days. This is going to be good for 10 days, and then you can go forward. So that is the loan estimate, guys. So if you have any questions, leave them in the comments. Hope you enjoyed that. And yeah, and you can also go to consumerfinance.gov and use this address here, and you can check it out yourself. All right, talk to you later, guys. So as promised, loan estimate based loan hack that will get you your best rate with the lowest loan cost without facing any of the typical objections or barriers from the loan officer. So many people are going to tell you to get multiple loan estimates to compare which lender will give you the best deal. The problem is when you request these, you will be faced with a million barriers from the loan officer, because the fact is there are several pieces of information the loan officer will need before they're able to provide you with an official loan estimate. They'll need your name, social security number, income, desired loan amount, property address, and the estimated value of that property. And even worse, they will have to pull your credit to provide you with the LE. Now, my first loan hack is that if you do want to go through this whole process to get the LEs, try to find a property address that is in the price range of what you are looking at and get your estimate that way. For the estimate, it doesn't need to be the one that you end up purchasing. Just try to at least go to one broker so that they can shop around with multiple lenders with one credit pull. So a much easier method for finding out the rate and cost is to give the loan officer your best guess on your credit, give them your price range, your income, your debt, your monthly debt, and let them put together an estimated cost sheet based on that. It isn't official, but it won't involve pulling your credit or face the same barriers and multiple things that you need in receiving the quote. Having this quote, you'll have all of their typical fees. The only thing that may change is the rate, which will be out of the loan officer's hands either way. Also, typically when one lender or broker is lower than the other, regardless of the rates going up or down, it usually remains consistent that the lower lender will remain lower on the rate. So there you have it, everything you need to know about the loan estimate, along with a loan hack that'll help you compare lenders and get your best rate and lowest costs without facing the typical barriers to receiving a loan estimate. Please leave a comment below if I missed anything or you have a question. I'd love to hear from you. If you gained value or knowledge from this video, please do me a favor and smash that like button so more people just like you can see this info. And if you liked this video, I'd like to invite you to watch one of my other videos. Over here, I walk you through the complete home buying process step by step. And over here, YouTube has determined that you may enjoy this video. Thank you for tuning in, and until next time, best of luck.